Hey, everybody, welcome to the video podcast. Thank you for joining me. It's been too long, hasn't it? But the markets have been turbulent, so we've been busy, and we try to do these podcasts as often as we can, but it takes a little time to do them, to prepare them, to get them out to everybody. But so right now we've got about an hour and a half to go in the this current session, and I wanted to go ahead and get this out to you guys. So where are we right now? We obviously had the big sell-off, and right in here, you know that. We had those days that were, I think we had 1% down days in a row, which is very unusual. So we knew we were going to get a bounce at some point, right? This was it wasn't as big a percentage as the 1987 crash, but in terms of the fear, in terms of the steepness, and just the all-out panic, it was pretty close to a multi-day crash. And, of course, we've been hearing about 7-year cycles, and we've been hearing about all the stuff that has been scaring people away from the stock market. But we knew we were going to get a bounce. And so, again, what we've said was, when you're getting this cascading down, that's not the time to sell. As hard as it is to hold in there, it's not the time to sell. So we did get the subsequent rally. At this point right up here, we went ahead and one of our positions, what we kind of call our contingent core, it's in a couple of different strategies, and it's about a 20% equity piece that's designed to either be in the market or out of the market. And it can furthermore go short if we want to. But we basically, at that point, felt like based on, and it wasn't just us looking at the markets and saying we think we want to take that out. It is a system we look at pretty much on a monthly basis. It's a longer-term indicator. We started doing it in 2012. It had not been out since then. This is the first time it's been out. So it was a pretty substantial call. We sold at that point. We saw a little sell-off. We saw coming into the Fed day that the market was actually rallying. And again, didn't do anything about that. We had this reversal. So this was the Fed day when they said they were not going to raise rates. Market initially jerked up, reversed course, headed straight down. It looked like everybody was saying, we're going to get this double bottom. And came short of it. We had the big reversal on Friday last week where the jobs report was weaker than expected. And we'll talk about that in just a second. And the market reversed, had its biggest reversal since 2011. And we've been up really ever since. So you're seeing that, and now I would say instead of, for a while there, what we were seeing was this kind of wedge pattern where we saw this and we said, well, it's coming, and it broke down, right? And so everybody thought we're just going to go straight on down to zero. That's kind of how people were feeling and acting. And now what I think you're in here is more of this box, right? Now we're establishing this little sideways box, and so I think the easy trade right now is to say, okay, sell everything and short the market because we've bounced up to here before, and now here we are again, and this thing's going to roll over, and it's going to come back down to at least here, and I can make the money. Then I'll buy cover the short, and we'll write it back up. And it's not going to continue to do it forever. This is a very typical pattern. What we're going through right now is a typical pattern, which is you get a big sell-off, and then you get this just sloppy chopping you up. If you're trading it, it's very difficult to trade, even intraday, because of the big moves. And so, why is it going up right now after we've had what seems like worse news with the economy the last few days? Is it because investors are saying, okay, the Fed's definitely not raising rates this year? We know that. And furthermore, maybe they are going to do quantitative easing version number 4. Is that why the market's going up right now? I sure hope not. Although it's shown a history of doing that, being addicted to this stimulus, but I sure hope not. I felt like the stock market would actually welcome rising rates, and maybe it's been begging for it. Maybe the last few months, I don't know. We don't know how it would react if the Fed were to really raise rates. But bottom line is, when they said they weren't, the market did sell off. Since then, we've seen a weaker jobs report, and keep in mind, not only was it weaker, it was revised down the previous month as well, and that was really, to me, the big kicker. But these are data points that you string together, and you can't take one jobs report and say things are awful, or conversely, if it was really good, things are great. You need to put these together. What we have right now is we know there's been people leaving the workforce. We know there has been people quit looking for a job. We also know there's people in jobs that they are qualified to be in a better paying job. But here's the thing. The employment to population ratio, which we watch, has been turning up. Okay, we know home sales are doing well. We know auto sales are doing well. But there has been some softness in the last few months. And given all that, and given what's going on globally, things are fragile. They're still fragile. So this market has been acting as if it's fragile. And the thing is this. I think when you look at what happened here after this, this kind of breakdown right here, I think earnings on the S&P 500 are flattening out. The growth rate is flattening out. So given that, it makes sense that, okay, well, if we're paying a valuation of so much earnings, 10, 15, 20 times a year's worth of profits, and that growth flattens out, you always factor in some growth. If the growth isn't there, then stock prices are too expensive. So now, instead of us being in this range and assuming a certain earnings report, are we now in this range? Did we just come down a level and we're going to move sideways from there? I don't know. Too early to tell. But let's go through some of these charts. You can see the Dow Jones, again, easy resistance right here. Could we roll over here? Absolutely, especially when we've had these 4 or 5 days in a row. Let's take a look at the S&P, a little different picture. It went down a little lower. I would say that this one was more about the, again, you can see this kind of wedge broke as well. But I would say this one, people are saying, hey, it was a successful double bottom test. So far, it looks like it. I don't know if the market's going to make this kind of W pattern and off to the races we go. I don't think it'll do that. I still think we'll have some sloppiness here for a while. But this is the fear of, again, whether you're too bearish or too bullish. If you came in here and said, the Fed didn't raise rates, I'm going to buy. The market went from essentially a little over 2,000. And in short order, it went down 7%. And then since last Friday, has gone up as of right now about 6%. So wild moves. It's almost, I think, trading an hourly picture is one way you can look at it. One of the stronger areas has been the Russell 2000. Some interesting stats about this. The Russell 2000, and you can see this little, we're getting at the top of the range there, if it's a range. The interesting thing about the Russell 2000 is that it broke down. It actually went lower here. We actually had a lower low. So it broke down even further. But if you look at studies would suggest that that's not a good thing, but actually the data behind it is that the stock market actually does better going forward when it breaks down to a new low, but the S&P does not. So that's an interesting stat. There's a lot of positive things going on. The burst of energy we saw the last few days in the markets is something that has typically led to rallies. We've talked about the fear being so high that that's led to rallies. So again, I'm kind of constructive in the shorter term meaning next few weeks perhaps, but I think what's possible is that, again, what we want to see is, does this stock market start to work its way higher? Let's say it pulls back a little bit. We get a little more of a pullback. We get a little higher. We're kind of working our way higher. If we get up here and this thing starts to roll over, or up here, wherever it is, but it starts to roll over, and we know that the internals continue to weaken, which they have been, that would be the time for me to get much more aggressive on the defensive side, whether that means lightening up on stocks for sure or going short the market in a more aggressive way. Because, again, you're seeing some leadership breakdown, right? I mean, if you take a look at Apple, which we own in our Dividend Plus portfolio, Apple doesn't, quite look as energetic as the market has the past few days. How can it not be? I mean, it's down today 1%, while the averages are up. The mid caps are up 1%. The NASDAQ is up 42 basis points, and yet Apple's down. So the leadership's going away. We also know biotech is that bounces over, and we had a blog post about where could biotech. Remember, Hillary Clinton started the biotech attack. I think it was on this day. Had a huge sell-off very fast. And we said, hey, you know what? Longer term, it looks like this is a good bounce point. We said it could get to somewhere between, we put a little box, and you can go look on the blog about it. But we said we think it gets somewhere between 320 and 340. It got to about 321, 323, something like that, and now it's pulled back, and that trade's over for now. So there's still some stocks we like in biotech, but my point is that the leadership, biotech, Apple, that's been waning, and that's not good. for the overall market. So we need to see that leadership come back. And if we see the leadership come back and we see the volume increase and the demand really pick up, fantastic. But if we just float higher because the short sellers are temporarily on hiatus and we just float into this box based on the internals getting weaker, that would cause me to short more. But I'm not going to short aggressively down here when it's already fallen. So that's why we waited for this thing to bounce, and then we took some off the table in this area right here. So, it's still we've gone through some, hey, that's good, we took it off the table, to last few days, hey, it would have been good to buy it back down here. But the indicator we use is a very specific one that takes out the emotions. We look at it once a month, and we basically trade on it once a month, and it's a longer-term indicator. And right now, it's still out, and here we are in the middle of the month. So we're not doing anything with that portion. We still have enough money invested in stocks to where when the market's going up, we benefit handsomely from that. But we're not out of the woods yet at all. Okay, so don't think that. But I do think we're in for some more choppy trading. And certainly the earnings coming out over the next couple of weeks here, 3 weeks, will start to give us a framework. Of course, I think people are going to blame, sometimes they blame their bad earnings on the weather. Sometimes they blame it on, they'll blame it on the strong dollar. We've heard that. So they'll blame it on something. They're probably going to blame it on China this time around, right? But we want to see what their guidance is. They're going to lower expectations a little bit, but let's see how companies react through that. If we go ahead and take a look at oil, and this is USO, which is the ETF for oil, if you want to trade that, been working higher. We had talked about, I think in our radio show and our podcast, that energy was looking really good to us as a long-term investment and as a trade, but even as a long-term investment. And you're seeing that big, powerful move. You have energy up about 15% in the last five or 6 days, doing really well. And I just think those stocks have looked really good. If you look at let's look at Chevron, for example. These things were, you can see, they were moving sideways for a while. We kind of had this, the Bollinger Bands got real tight here. The moving averages started to flatten out. That was the first sign. And now we broke the downtrend. Okay, now we're kind of pausing here, maybe the 100-day moving average. So again, look for this to pull back a little bit, but I think energy is going to start to work. Obviously, tensions overseas. Some of the fundamentals are getting a little better from a supply side. Obviously, getting the demand side back would be helpful. And some of the stuff was just beaten up silly. So if we take a look at gold, gold's having trouble today right at this 100-day moving average, which we don't hear about the 100-day moving average too often, but I like to look at it. Here's the 100-day moving average, which is the purple line right there. So you can see this is bumping into it. But the gold miners themselves have looked pretty good. I wanted to take a position in this, but to be honest, it moved away too quickly. We were watching this setting up, kind of building a base here along the bottom. And you can see right in there, just boom, 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 bouncing. And some of the other indicators are starting to turn up, but it's blasted higher. And so now what we want to see is a pullback, and then eventually, a pullback maybe a third to half of the way down from here, and then start to turn up again. And that might be a good entry point. And then perhaps you could make a run to the 200-day moving average, which, if you can get it around 15 and it goes to 17, that's a good trade. So the gold miners have looked interesting, like them better than the actual gold-looking chart itself. As far as interest rates are concerned, I thought it was interesting. We broke 2% the other day on the bad jobs report and kind of reversed that day when the stocks reversed. And we're still hovering around 2%. But remember back here, February of earlier this year in February, we were at 1.6%. So if the economy is getting so much worse now than it was there, why are interest rates higher? So I think that's interesting to watch that dynamic as well. Volatility index is starting to settle back down again. Of course, we had that huge spike. It's coming back in kind of the lower volatility range. So that's kind of it. I guess if we want to look at international quickly, I still like international a lot. I think longer term it looks good. And, of course, it's been nasty. But I think if you go back and look relative to the Americas, the international versus domestic ratio has been underperforming so badly that I think international will start to outperform at some point here. And again, if this dollar stabilizes or goes down a little bit, oil will continue to go up, gold will go up, emerging markets will go up. So there's a lot of stuff that can work even if the Dow and the NASDAQ and the S&P don't. So that is about it. Again, keep your questions coming, like answering those when I can, and we'll go over more about this. But just to kind of sum up right now, I would say, if you shorted down here, not a good move. If you bought right here, not a good move. If you're buying here, is that a good move? We'll see, but certainly I wouldn't be aggressive just yet. The easy trade, one thing I would watch out for, though, is that the easy trade, based on this box we're in, the easy trade says short this because it's going down. If we get a little pullback here and we burst out higher, that's going to be a lot of short covering in there, and we could go substantially higher and end this whole thing. And if that's the case, then we need to check. This is the point right here where we would check to say, what do the internals look like, especially compared to where they were here? If they're worse, then I will be very cautious and lightening up a little more aggressively, because right now, we're kind of in the middle, right? We're in the middle of this whole debacle where here's the old high up here and here's the low. Where are we? Well, we're right here in the middle. So we don't really have an edge other than to have a balanced approach. And I still am looking towards income. We're diversifying into alternative type strategies that aren't correlated to the stock market. And, and we talked about on our radio show this past week, and, is this 2008 again? And we would say the answer is no. However, we are diversifying into other assets in addition to the stocks. And there's still good companies, and there's a lot of cheap companies out there right now. I think one example, and we own this in our Dividend Plus strategy, is General Electric having a big old move. So think about that. That flash crash morning of the 24th, GE was at $19. It's at $27 now. That's a 43% increase, guys. But this is the type of company right here that you're starting to get activist shareholder in there, perhaps $275 billion company, and but having a kind of a vertical move. So there's a lot of stuff that's starting to work. And so again, watch this. I don't see a huge edge one way or the other, but I would say the easy trade is to short the market, which could mean that there could be some short covering if we blast a little higher, especially some of these earnings reports coming in. So far, we've seen some earnings reports that have been bad, and the stocks have gone up because they're fully sold out. The bad news is priced in. If you know something already, everybody else does too. Remember that. All right, have a great evening and afternoon, and we will see you back next time. Don't forget eggerscapital.com. We have our radio show every weekend, and we're on Facebook, we're on iTunes, Google+, Twitter, @Karl Eggers is my handle. Thanks, guys. Appreciate it.